Is it me you're watching now? This is your good hostess with the mostest, Professor Naragon, bringing you the best hits again, back with 2302 and bringing you Chapter 19, Variable Costing and Analysis. Woo woo. So, what is Chapter 19, you may say? It is basically going to be a very sort of simple, easy chapter in the way that it's operating. It is going to take stuff that we've already learned, like chapters 15, 16, and 17, where we discuss various ways to allocate overhead. So again, we've done plant-wide, we've done departmental, we've done activity-based, but we really haven't discovered the behavioral part of these. So, how does this change? Does it help us? Who uses it? Why? A who? A what? A where? How? What we got going on here? And we're going to introduce that's right, two costing methods that are used to determine the product cost and for decision making and external financial reporting. These two are, of course, known as absorption. Ooh, did not pronounce that good. Absorption costing and variable costing. And the key thing that's going to be the difference between these two is one includes fixed overhead and one does not. Obviously, the one that says variable costing will not cover fixed overhead. They consider that part of the period cost. While absorption does everything. It kind of basically is like the Blob. If you ever saw those movies, that's absorption, and it's absorbing everything. Well, variable goes, I don't like you fixed. Get away. Go, go, go. We don't care. Okay. So, really, this brings on some advantages and disadvantages of basically how are these two different. They can either have a small difference or a very big, large difference. And it just depends on how fixed overhead is. Simple enough. One includes it, one doesn't. So how do we get a small difference between these? Well, easy one is if that fixed overhead is really a small percentage of overall manufacturing cost. The difference between the two methods, really, there is none, because it's too small. So we'll have a very small difference, and likewise, if there's a large fixed overhead percentage, there should be a large difference. Kind of the yin and yang, opposites attract here. So, again, when inventory levels are low, basically, this means inventory dollar balances will be low and any difference won't be material. We don't have the inventory in there to actually create a ton of fixed costs. So, I mean, there's no storage, there's no cost of goods is kind of very already expensive in many ways. And then, of course, the opposite. If we're low, we get small. Well, if we get high, inventory levels are high, well, must mean there's going to be a large difference. There's greater fixed overhead going on here. Again, it all changes on fixed overhead. Next, we got inventory turnover is rapid. Because fixed overhead costs are expensed as period expenses on the variable. And our expenses cost of goods sold under absorption cost. A high rate of turnover basically means the fixed overhead costs are flowing to the income statement under the two methods at a similar rate and thus should not lead to any large differences. Basically stating with a fast turnover, fixed overheads getting expensed very quick as cost of goods sold under the absorption method, and it's already being put as an expense under the period, on the variable. So there's nothing really slowing it down. But if the turnover is low, that means it's sitting now. Since Under the absorption method is part of cost of goods sold. A low rate of inventory means that fixed overhead costs are basically flowing under different rates. They're flowing faster under variable costing because it's not part of the product cost, thus basically saying, hey, you're already expensed when we get it, we're not worried about you. Absorption holds on to it until the products are done and put part of cost of goods sold. So when turnover is low, we'll have a very large difference. Also, when we look at the long run of things, we have a longer period of analysis, which also will make the differences relatively small. When you stretch out something, eventually they come together. Well, when you look at a short period of analysis, usually you're going to have a huge difference. Again, it's all because of fixed overhead. One takes it, one doesn't. So the key thing here, the difference between the two, fixed overhead and how does it work. So when we do this, again, remember, this is a key thing here. Remember, product costs are added when the product is in production and will be transferred to finished goods upon completion, and then are expressed as a cost of goods sold when sold to customers. Always remember that. That's just a repeat of prior chapters, and if you haven't remember those, the videos are still there. So always check, keep a refresh. Remember, this course all builds upon itself, which is awesome. Yay! Thumbs up. Alright, so the best way to actually bring in these two methods is to go ahead and give you some examples. So we're going to have this example right here where fixed overhead cost is that small percentage. Okay, so if you use that chart, you're going to notice that because it's a small percentage, they should be relatively close to each other. I have for this a manufacturing company that has direct materials at $6 per unit, direct labor at $14 per unit, and overhead cost with variable at $220,000 and fixed at $100,000, with expected unit produced about 20,000 units. So when we look at these direct materials per unit, again, we usually use a per unit base, is $6 for each, $14 for direct labor. Now we got $11 and $5. Since this is for per year, and we know we've produced 20,000, have to remember, divide the units into the dollar amounts. That's where the 11 and 5 came from. Now notice, again, our product cost, what is on the balance sheet until it goes to cost of goods sold, for variable costing is only $31 per unit. This $5 automatically gets spent out. It goes right to the income statement according to variable. Or absorption, it's only $36 because it adds them all. So again, when we actually look at the total cost, total product cost, zoom, you want to see we take the 31 product cost times 20,000 units. That gives us 620,000. Under absorption, you get 720,000. We have a difference of 100K. I know it seems like a lot, but that's very small according to our next example. So our next example decides to put it as a large percentage. So as you can see, numbers are basically the same, except from 100,000 in fixed overhead, we decide to jump to 680,000. Oh my! We really had a lot of fixed costs going on. Well, doing the same items, once we divide 20,000 units into 680,000, we find out fixed overhead is $34. Well, again, variable costing doesn't use it, doesn't need it. So it's still going to be $31. But on absorption, it keeps it, and now from being 36, if we had $5, it's now a whopping $65 per product. Well, if we times these, just like before, to find our product cost, I mean, nothing's changed with variable, but absorption is now a grand total of $1,300,000. Oh, it's nearly pretty much doubled the variable costing in a lot of ways. That is a lot. And with that, you can see already there can be some misleading numbers here if we put out the variable costing to investors instead of the absorption. It's eliminating actual cost. And this is the reason why we have this note right here. Okay? This note right here specifically states to not mislead. Okay? Because again, this is very material and this can be very misleading if we use one over the other. Variable costing cannot and will not be used for external financing reporting purposes by GAAP. Okay, by our GAAP, it is not allowed. So we can't do that for anything that goes outside of the company. Now, we will be using variable costing internally. Again, this is managerial accounting, and we deal with a lot of internal stuff, but we can use that for internal use, but never for external. It can never show up on the financial statements to any investors, to the SEC, to the IRS, anything outside. So, absorption costing is required though by the GAAP. And again, not the clothing industry, not that store. If they had that much power, they probably wouldn't be going out of business right now. But for US GAAP, for external financial reporting, and can lead to poor managerial decisions if the managers decide to use that. So you're going to see we're going to have these two running together, but only one's used for internal. While we can use absorption, we tend to favor variable in a lot of scenarios. And this is mostly due to that inclusion of fixed overhead costs. Again, if a manager decides to make decisions with that included, it could actually make wrong decisions. So that's why we have variable, to pull out the one that everybody gets. Alright, let me zoom back out for a little bit. Alright, so implications on net income. How do these two methods use, and can they have an impact? And mostly the impact is due to timing differences. Again, what you're looking at is fixed overhead. One actually puts it out as a income statement cost, while the other keeps it until stuff is sold. So, first thing, units produced equals units sold. So we sold all of our units. We produced and we sold them all. Well, variable income will equal to the same thing. It will equal absorption, because everything's being sold. Under variable costing, again, the product cost without is expense as cost of goods sold. And since all the inventory was sold, all of it was cost of goods sold. And additionally, all the fixed overhead was expenses, period. Thus, anything related to manufacturing has been expense on income statement. Under the absorption cost, the product cost includes everything. It was all included in cost of goods sold, and thus all manufacturing cost was expense. So the total expense are the same under each method. Now, of course, in this world, not everything's going to be equal. We either going to produce more than what we sell, are we going to sell more than what we produce, especially if we have an overage from prior. So, what happens when production is greater than units sold? Well, that means variable income is going to be less than absorption income. Huh. Why is this? Alright. So, we're producing a lot of units. We didn't sell a lot. So, our variable income is less. Well, let's look at this. Under variable costing, again, production cost, and the units which were actually sold to customers are expenses cost of goods sold. The units that were not sold to customers do not have these cost expense, but instead held on the balance sheet as finished goods inventory. Again, they're being capitalized. These will get expensed later when the units are sold, but the fixed overhead is still being expensed. So, even though I'm holding on to these products, I've already expensed out the fixed overhead. So those expenses are increasing against my revenue, thus lowering income. But under the absorption cost, that fixed overhead that's related to units which are sold are expenses cost of goods sold, but not sold is all being capitalized. And it's capitalizing that fixed overhead that variable is giving out. So there's less expenses due to that fixed overhead, thus giving a higher net income under absorption method. Okay? So our difference between the two methods is the amount of fixed overhead cost. Again, that's in the finished goods. I think y'all know the running theme, right? That fixed overhead is really a pain in the butt when we actually look at it. When we're looking at these two methods, we have to know this number. You have to know it. You can't do anything else without it. Well, again, third scenario. Well, what do you think? If units produced is less than units sold, then variable income should be greater than absorption income. Same scenario that we got going on here. Again, these units produced, fixed cost was already expensed. We sold more, so we're selling more of our variable. So our income is going to be already greater. We've already expensed the fixed cost under the variable method. But under absorption, since fixed wasn't expense until it's sold, well, if we sold more than what we produced, under absorption means now we have more cost, more expense than the variable. So, with that being said, of course, our absorption income is going to be a lot less. So again, the primary difference is the amount of fixed overhead that were in finished goods prior period and are now being sold and expensed in this period. So, again, this is basically what happens if this happens. One period, absorption income is going to be great. Then once we finally sell everything, it becomes less. So advantages and disadvantages. So, quick way to actually find the difference between the two methods is simply this. Units produced minus units sold times fixed cost per unit. If we use that, we can always find the difference between the two, and it makes it so much easier. So why do we use this? Why is this important? Now, I kind of alluded to this a little bit earlier with between the internal and external, how management probably uses it. So, big thing is inventory levels do fluctuate with sales activity. Some years we'll see more produced than sold. Others we have the opposite, more units sold than produced. Over the long range, the difference again ends up being almost zero. They kind of just basically change out. Like I said, the cycle that's right here. When we have this greater eventually it's going to flip. So eventually this will flip. So they're basically even out in the long run. Okay? But the difference between the two methods will be more noticeable and be able to be analyzed during the shorter period. So we tend to use these two again during the short run, where basically all of our business decisions are being made because we want to stay good. So we'll have first in certain methods. The first method that we have in business is, of course, production planning. So we've been having a problem here. If production bonuses are linked to income computed under absorption cost, which is common because of GAAP. Thus, there will be an incentive to increase production and hold excess units in finished goods inventory. Again, production is beating out what's sold or holding on to that fixed overhead cost under absorption, and it's not being expensed, thus leading to basically a fake higher income. Okay? But we're basing bonuses on this. So why is this a problem? I mean, we're showing good income. Well, this basically means net income can be adjusted by change of level of production. Manager can just say produce more inventory. Thus, it's being held and not being sold. Problem that this happens is that this leads to a lot of inventory in the warehouses, which of course leads to higher storage and maintenance costs. So it's adding more fixed costs. And if the inventory is never sold because this manager won the bonus, shame on that manager, then the company will have to dispose it at a loss, basically losing money in the long run. Or short term, same thing, because basically, if the product becomes obsolete, well, you basically have to get rid of it, you sell it for nothing, and it's just a huge loss. Why? Because this manager won the bonus. So how we fix this is simple. We link the compensation to variable costing. This basically means they are in charge of anything that they can control. They can control fix. So if that's taken out, now the manager is basically in control of the expenses, how much income is actually going on, because fix is automatically being sold off. So basically it prevents that artificial adjustment to net income and requires the company to actually sell inventory to customers to improve profits. And it works. Definitely works. Makes people sell like crazy. Just like in Dunder Mifflin. Or Mifflin. Something around there. Next is setting prices. Okay, here's our next scenario thing that goes on between the two. Prices must be high enough over the long run to cover all costs, variable and fixed. We know this from prior chapters, while still, again, providing a good return. Definitely want that return, don't we? So since variable costs do not include fixed overhead costs, this basically means the best method is the absorption costing. Again, that includes all costs. If I want to beat out a price to cover it all, absorption is going to be the best. So, first off, we determine the product cost per unit using the absorption costing, which again includes the fixed. We figure out what the target markup we want is per unit. Basically, what the cost plus the little profit that we want. And we add this markup to the product cost under absorption to get our selling price. Seems a little lot with the steps again. So let's bring in an example. Example! Thank you, example. Suppose ICH Co. has a product cost per unit under absorption of $25. and wants to reach a target market of 60% above cost. Thus, what would be the target selling price to accomplish this? Well, if product cost is $25, the quick and easy way is this formula right here. Since we want to go a markup of 60% above cost, times it by 1.6. Basically, it's converting the 60% to 0.6 and add one front because we want to be greater. We want to take that and add basically 60% of the cost. So that means we get $40. Well, say you want to go through the 3 steps, which is fine and dandy. All you have to do is take the product cost, which was $25. Take in step 2, we figure out the markup, which is taking $25 times 60%, which means it's about $15, and just add the 2. Boom, there's $40. Okay. Now, right now with our selling price, there is certain other things that we'll get into. One is special order pricing that can be analyzed using product cost under our method. That can lead to a little misleading decisions due to the fact fixed overhead is being incurred, regardless of the special order acceptance. So under this scenario, really only variable costs are relevant and we actually take out the fixed overhead. But we don't get to that till that glorious chapter of 23. Yes. Previews of things to come. Special order price. So, not there yet. The next decision that we get, though, next one that we make a decision based off these two, is controlling cost. Okay? So managers are accountable for costs that can be controlled. Then the measure used to account for fixed overhead costs can be greatly impacted for effectiveness of managing cost controlling measures. In other words, variable costing is kind of a little bit better on this. Reason why? Variable costs are typically controlled by production management. They're the ones that are handling the products. Okay? While fixed cost is typically handled by the higher level management, the CEOs, CFOs, the ones above the production management grade. Due to this difference on controlling costs, absorption doesn't work too much. It's harder to find that actual effectiveness because they're combined. But under variable, they're already separated out. So I definitely can see who's doing their job. Are the higher ups actually controlling fixed? Why is that so high? I can blame it on the higher ups. But if variable costs are so big, or they're inflating, we know it's production management that we have to see how are you controlling these. So with that being said, this is a good way to actually control and see which department is doing the best. And then again, later on in this course, we're going to talk about what we need to do to remove or fix. Okay? So, the last decision, and basically getting close to the end of this chapter, is that we have the cost volume profit analysis. That CVP's back, baby. Yeah. And it's coming back. And these two methods do impact break even. Okay? Under absorption cost, again, there is no difference between fixed and variable cost. And under GAAP, all costs related to production are expenses cost of goods sold. Thus, absorption cannot help us with break even. It is so harder. As remember, break even has to have a separate variable and fixed cost. So of course, variable costing helps us because it separates. So it makes life a little bit easier in that way. As you can see, having it separated does make stuff work. I mean, it helps us with more internal documents of figuring out the numbers. But let's say we did everything in variable costing because of these reports, because it's better. But we have to get to the absorption cost. Well, we can convert. And sometimes this is just easier to do, okay? Instead of having two different financial statements, we typically just convert. And conversion typically happens again once we're doing external financial documents, the balance sheet, income statement, statement of retained earnings, cash flow, so forth, and for tax, because tax requires absorption too. Can't do variable. So we can do it this way. We take our net income under variable costing, we add ending inventory of fixed. So under absorption costing, what fixed overhead cost in ending inventory would have been. Subtract fixed overhead costing in beginning inventory under the absorption cost, and that would actually equal out to our net income under absorption cost. So yes, we do have to kind of figure out fixed overhead, but really adding and subtracting basically the beginning and ending of those amounts of overhead. And that's it. That's how we get to net income under absorption cost. And that's it of chapter 19. Woo! Chapter 19, done in the books. So, if you have those questions and you just need to let them out, put them in the comments below. I will make sure I'll get to them and answer whatever questions you will have that's pertaining to these chapters. Any other questions I can try to answer, but you probably won't get the correct one. Anyway, so this adventure of chapter 19 is all wrapped up, and basically we're going to move on to the next few, give you another exciting adventure. But this is your friendly explorer that's leading you on, Professor Naragon, signing off.